Thanks for having me. It's great to be here, and welcome Mike and Richard. Here we've got Richard Blumberg, the founder and managing director of Now Finance, along with Mike Laing, the executive chairman of ARCA, the Australian Retail Credit Association. Thanks for joining us. Richard, we might start with you actually. You've got over 28 years of experience in the financial markets, so you've seen a lot in your time. When building a business in the non-bank sector, what can really make you set apart from the rest?
It was a very exciting journey for us, and when I first started I had very little idea how complicated the whole lending environment was, but what worked well for us was really understanding what our value proposition was up front and building the business around that. Also having a clear path to funding. So one of the major barriers to entry in our sort of business and building scale is being able to access funds. So having a clear path, understanding where you're going to get your funding, and finally investing heavily up front in legal and compliance work to make sure you have a framework that is sustainable and that you can rely on for some time to come. A lot of new entrants to the market will come in and sometimes make mistakes which cost them dearly. So while it's a big expense, that was really something that we did well at the beginning.
Mm-hmm. Non-bank lenders have just 10% of the market at present. Do you see that growing in the near future?
I certainly hope so. You know, the personal loan market, 90% belongs to the banks, and of that, 82% belongs to the Big Four. So there's enormous concentration. The banks, by their own admission, don't do personal lending very well. They far prefer to give you a credit card and a mortgage than they would a personal loan, which is quite specialised and requires a bit of effort and focus. So I think with the growing non-bank lending sector, I think it's inevitable that our proportion of the market will grow. And I think it's important that we have a well-established and credible non-bank lending sector that people can look to with confidence and understand that they can actually, they have choices. They don't have to go to their bank. And in many instances get a better priced product with certainly higher levels of service.
What's your take on that, Mike?
Yeah, from my point of view, I think it might be that that the banks have sort of 90% of the market now. If you go back when I first entered the unsecured consumer finance market 30 years ago, that actually wasn't true. And I sort of thought about that, and I thought, well, what happened that turned the market and basically meant that the personal loan market was sort of cannibalised and turned over to the banks. And it was basically one of the principal moves was actually the development of the debit card system, the actual EFTPOS market. So there was a technological change that enabled cards to be taken at sort of point of sale. Credit cards, if you are old enough to realise, in those days was a lot of paper-based systems, and if you went into a retailer to use your card, if the transaction was above a certain level, that actually the point of the person in the shop would actually have to go to the back, pick up the phone and actually call the actual credit card company to get that transaction authorised. The big change was that when EFTPOS came in, presumably it was actually designed for the debit card system, that allowed credit cards to get online authorised sort of purchases. That changed the fundamental thing because the retailers up until that point, a lot of them had their own private label card programs. And because they had this access to the customer, privileged access to the customer at that point of sale. As soon as the credit cards got into the point of sale, then the banks had their own sort of customer bases, and then you saw the cross-sale happening. Plus you saw the credit card proposition itself was actually better because you could use that card across multiple retailers. The statements were actually better and also had this thing called credit line upgrades over time where you'd usually start out with a small limit, and then if you used it properly, paid it back in time, you'd suddenly find, it's not legal today, you'd suddenly find that you'd get a $5,000 credit line increase without even asking for it. So there was some factors happened back then, and credit cards have had a dream run, a 30-year dream run since the EFTPOS system came in. It seems to me that just about all the benefits that the credit card system had then, which caused them to gain share, have actually been neutralised and in some cases reversed. Because you don't need, cards are now shifting to other form factors, lots of other lenders through IP protocols, etc., can get to point of sale. And you've also got the actual rules around credit lines and the way you manage credit cards tightening up. So I think the factors that created the advantages for the banks have actually been neutralised.
And would you say that people are becoming more savvy about their options as well?
Well, there's a lot more options. I think whether consumers are savvy, I certainly think there's a new generation of first-time credit users that don't see credit cards as their principal form of kind of credit. So they've got a totally different attitude.
Yeah, Richard?
When we set up our business, we positioned ourselves as something quite different and separate from the credit card environment. The whole point of sale environment is quite crowded. There's the credit card companies, there's interest-free product. And we specifically wanted to position ourselves as something quite different. So our average loan size is about $24,000 unsecured and about $34,000 secured. And so it's for larger purchases where a customer is better serviced with a lower rate, fixed rate, fixed repayments over a defined period of time and can pay it off, as opposed to putting a large amount like that on the credit card, which becomes very expensive and often becomes quite circular. So we try to position ourselves as something quite different and move away from what we felt was quite a crowded environment.
And how would you say success is measured in this market?
In our market?
In your market, yeah. And how important is something like scalability as well?
I think it does come back to the economics of your business. So we're a balance sheet lender, so we have warehouse funding from banks, and we then transfer pools of loans into note programs. And so how you structure your business and your cost structures and your funding structures, and are you able to bring your cost of funds down, and at what point you become profitable, really does drive success and what is scale in your business. And so for a business like ours, we are profitable. We have been profitable for a number of quarters, but our book is $180 million. So it's how you structure the business. It's the economics of each loan that you write, which goes back to things like your credit appetite, who you lend to, and also how you fund yourselves.
If you look at the fastest growing unsecured products that are hitting the market, such things as those buy now, pay later schemes, what's given birth to these products, and can we expect to see more of these hit the market? Mike?
Well, I think those products just reflect that change in the sort of parity between other types of products. So the credit cards sort of benefits the 30-year sort of growth that they've had, and the reasons why they took over point of sale, I think, have actually been neutralised. So I think those types of products can actually come in and sort of take that niche.
I think millennials and convenience is also a big factor with a lot of these smaller dollar value loan style products which are interest free. It's the convenience, it's being able to get something now, and it's what we used to call lay-by in the past, except now you can actually take the goods and pay it off over a few months. So I think that's been a big factor.
Comprehensive credit reporting comes into effect shortly. What does this mean for the sector?
Well, certainly for us, it's very exciting. It's more information to look at. I think the banks have had enormous databases in terms of their customer base and information that they have on their customers, and we can now, in terms of positive reporting, actually get a better sense of where people are and how well they're conducting their personal affairs. So we think it'll give us more information, which is fantastic, and allow us to buy better, allow us to, we know what our risk tolerances are, we know what our loss profile, what we want it to be, and how we want to operate. But with more information, we can do that better.
Yeah. Can you see risk-based pricing becoming mainstream?
I think it's increasing, certainly, and I think it will. And certainly in our direct product, it is risk-based pricing. And so depending on your credit standing, you can qualify for a better rate than someone who's not as creditworthy. And I think that's absolutely appropriate. One price doesn't fit all. I think the challenge for the sector is to make sure that it's done in a responsible way. And so it's not the bait and switch type scenario. Someone earlier made reference to your rate comparison websites, where it's rates from. Well, the customer should know what their rate is before they get invested in the process. And certainly in our business and how we've applied technology, that's something we've endeavoured to do. The customer knows what rate they qualify for before they go through the process. And so assuming they meet underwriting requirements, they'll get the loan at that rate.
Sure. We've just had our first question come through. How far away is Australia from becoming a cashless economy? Keep those questions coming too.
Sorry, could I just say on CCR, I guess and risk-based pricing, my message there is I think if you're a regulated credit provider and you're not involved actively in CCR within the next 18 months to 24 months, then that's a very dangerous point to be at, both from a market perspective and not being able to understand the actual customers and potentially having the risks from that, but also from a responsible lending, given regulated lenders have this responsible lending legal requirement. So if you're not involved, then I think there's something, if you haven't got plans to do it, then I would just say you need to think again. From a risk-based pricing, CCR will certainly enable that, will help that, be one of the tools. I would say, though, that one of the fears that some sectors have, certainly the consumer groups have, is that risk-based pricing, as Richard said, he said use it responsibly. One of their fears is this is going to lead to very high rates of interest, targeting some of the most sort of vulnerable people. I actually don't, or I guess my answer to that is, one, in Australia we actually have maximum rates of interest versus places like the US. And also I think Stuart Stoyan put a very interesting graph before showing how the cost of funds has dropped over a long-term trend from 1991 to right now versus the rates being charged on credit cards and other lending products. There's a massive gap there. So I actually think, given CCR both enables risk-based pricing, but it also in some ways levels the playing field to give everyone information about customers, it actually brings a lot more competition, can bring more competition into the marketplace. So I actually would expect kind of smaller margins rather than larger ones.
Okay. We'll go back to the questions. We've had a few come through. How far away is Australia from becoming a cashless economy?
Look, I think I've got a long background in payments as well. I think Australia's one of the leading countries in terms of moving to cashless. I'm not sure whether you can truly go. It'll be if you look at every payment stream that's ever been created in the last 50 years or so, that they are still there. Everything from checks. There are still places which you can use your credit card and use the old zip-zap machines. So I think the idea that cash will completely vanish, maybe. But I think it's a relatively cheap way. It's a universal form of payment. But we are seeing massive reductions. We're seeing check volumes vanishing. So the average payment size using cash is sort of dropping and dropping over time. So cash will be around, but it's increasingly going to be such a small part of the actual market.
Okay, a few questions here for you, Richard. What's your real competitive advantage relative to other personal loan providers?
That's clear. So our value proposition, as I said up front, we're very clear on what we wanted that to be, and we've stayed true to that. So one is transparency in our pricing. So a customer up front will understand what rate they're getting. Two is our simplicity of our product design. We've kept things very simple. And lastly, and very important, is our customer service levels. We have built processes and systems in our business where we're continuously looking at those SLAs and those deliverables and those outcomes and monitor them very carefully. Now, all of that we can do in a competitive way from a cost perspective in terms of our business model through technology. So we've got end-to-end technology that's fully integrated, and that allows us to do that in quite an efficient way, which leads on to the other question, was responsible lending and scaling technology. Our view on technology is that it's a very important part of our platform and offer, and it's an enabler. I think from a responsible lending perspective, we have credit teams and settlement teams that focus on the underwriting of those deals, and there's still a fair bit of personal interaction in getting across the responsible lending obligations. So we haven't looked to machine-based solutions to try and make it, something that is automated and done by systems. We still have a very focused credit and settlements process where, one of the key areas amongst others that we focus on is responsible lending, which for those people in our space know for the last couple of years that responsible lending has just been the most important thing if you want to remain on the right side of the regulator.
Okay. Mike, the UK recently banned all credit and debit card surcharges. Do you see this happening in Australia?
It might happen. I guess I'd just say, take it more generally. I was heavily involved in the whole interchange regulation that came in about, 14, a long time ago, 15, must be close to 20 years ago. And I link both credit card surcharging, mandatory CCR. They're the same thing. It's a government response to the industry not dealing with sort of problems within that sector. So in credit cards at the time, it was that the interchange rates hadn't changed for a long, long time. In fact, they were going up over time. Costs were going up, and the industry just thought they're on this gravy chain where they could keep ramping prices up. That was put in to put an end to that. Interchange was regulated down. Mandatory CCR was all about the government basically saying to industry, you guys advocated to get the law changed to allow CCR, and you're not doing it. Now we're going to force you to do it. So to me, the lesson of both surcharging, the way credit cards have been heavily regulated, the way CCR's now been mandated, is whatever, if industry's got practices or things where they're not listening to government, where they're not listening about people not being happy with the business model, then it's up to the industry to actually proactively deal with it and not wait to the government. Because then with mandatory CCR, rather than just doing it, we've now gone through this drawn-out legislative process, which I can tell you has been very as an industry association trying to deal with that, trying to get the government not to put laws in which make things worse, not just for the ones that are mandated, but everyone else. So it's a very critical thing, I think, that industry self-regulates as much as they can.
Sure. I think we've got time for just one more. With the introduction of P2P models like Zopa, do you feel like there's a place for the personal loan market in 20 years' time?
Absolutely. Unless I'm missing something, the peer-to-peer part of it is the funding solution as opposed to origination and servicing. So the origination and servicing is writing the loans, having a customer base that's interested in dealing with you. How you fund yourself, peer-to-peer, as a balance sheet lender, I think that's one of our real competitive advantages. We've progressed to the point where we've got bank warehouse funding, we've got active note programs, and we'll move into the securitization market next year, which is possibly the most efficient form of funding and one of the most significantly large and liquid markets. So we think we've managed to fund our growth with confidence, bring our cost of funding down, which continues to drop each year, and be quite competitive. So I think most definitely two different models, but certainly don't think one is replacing the other.
Mike, anything to add there? Okay, well, we've got to wrap up. We're over time, but please join me in thanking Richard and Mike.